Hello and welcome to episode 3 of the Technical Bootcamp. Today we are going deep into the concepts and topics of supply and demand. So this is one of the most important concepts in trading. I know I say that quite a lot, but this one is because this is actually what drives market prices. So rather than spending loads of time teaching you the same stuff you've already seen about supply and demand, we're going to start by diving deep into the theory of supply and demand and why that matters so much to become a successful price action trader. I'll show you how to identify and plot supply and demand zones correctly and why we do it that way, and how to successfully trade this theory as a whole. So with that said, get comfy, get some notes ready, and we'll dive right in. Let's go. So supply and demand is basically the driving force behind all the movements that we see in the market. Therefore, whether you're going to use these concepts or not, it's really important you understand what it is that actually makes prices appreciate and depreciate in financial markets. And that is generally basically how much available demand there is in a market, okay? So if we take a look at this chart, we'll explain it as we break it down. Here we have a point where demand is at its highest. When demand is high, supply is generally low. That's because, obviously, with everyone up here buying, supply is taken up. This happens in all markets. Think about the housing market in the UK right now. If you are in the UK, of course. Basically, everyone is buying houses, or there's too many people, not enough houses. Therefore, demand for houses is really high. Supply of houses is really low. So the price of houses appreciates massively, right? So price would look like this, with high demand and low supply. You can think of it with diamonds as well. There's argument that this could be inflated value because a company controls all the diamonds, but still they're hard to get. So a scarce asset goes up because demand is high and supply is low, right? Now, if we go the other way and we start to see demand decline, well, what happens as demand declines is people start selling the asset. So the supply of the asset will increase and flood into the market, right? This is true in financial markets as it is elsewhere. If you had a gold coin, for example, and everyone wanted that gold coin, well, you could charge pretty much exactly what you wanted because it's a very scarce asset and the demand is very high. However, if someone else comes along with 100 gold coins and starts selling them off for cheaper, well, suddenly this is not so scarce and they're more available and there's a higher supply in the marketplace. So there's still the same amount of people that want the gold coin, but now there's 100 more gold coins. Therefore, the price is going to decrease because people will see this as a less scarce asset. Supply will be higher, demand will be lower, and prices will decrease, okay? So what we see in the markets then is basically high demand leads to, or the other way around, low supply, or low supply can lead to high demand, right? If people are after scarcity, which creates price appreciation. So if we have not much of an asset and a lot of people want the asset, prices will go up. Think of a Rolls Royce. A lot of people want them. Not many people can have them. You can charge what you want for one. People will pay $1 million for a car at that point. Now, if you've got low demand paired with either as an effect of high supply or creating high supply. So let's say, as we said with the gold coin example, you've got high supply now, lots of gold coins in the market. Not too many people are that bothered about them anymore because it's not a scarce asset. So therefore, price depreciates, okay? So this is how supply and demand works. And this is basically the market psychology behind all of the movements that we see in financial markets. If we have a case where there's high demand for an asset, so there's a reason for people to want to hold a specific asset, then supply will be bought up, it will get more scarce, and people who have the asset can then charge more for it. That will mean price appreciates. Low demand, so if not a lot of people want to buy that asset, if something bad happens to a currency and people start selling it off, then of course the demand will decline. That will create more supply because supply will be being sold into the market, and that creates price depreciation. Not so many people want it, and loads of it's available. All right. Now let's explain then how this actually comes to be in a financial market and how this actually affects the prices. Okay. So obviously we know high supply, low demand creates price depreciation. Low supply, high demand creates price appreciation. So with that in mind, what is it that actually causes that then? So how does this actually make prices go up and down? Well, it's very much like an auction theory, okay? So let's say price is trading at this level. Now, suddenly there is a reason that people want to hold this asset. Well, now we have new people stepping in. So these are the new people coming over. These are the people that hold the asset. What these guys are going to do is now say, well, if you want the asset, you've got to pay me this much, okay, here, instead of this much where they got in. Someone's going to take that, and then what's going to happen if there are still people coming in for more of this asset? The next guy, this guy here, is going to say, okay, well, if you want to buy it off me, you got to pay this much, okay? So then someone's going to come in and take that, and then the next guy who's holding the asset might come in and say, well, you got to pay me this much, right? So basically, because people want the asset so bad, they will continue to pay higher prices, which is what creates the upward movements in the market. Now, let's say we get to a point where the direction shifts. People are less interested in having this asset now for one reason or another. Maybe another asset has become more appealing. Maybe this one has lost its yield or something negative's happened and people don't want this anymore. Well, all of these people now will start selling. So let's say we have the holders again. Someone's going to be like, can I sell this here? And a buyer might come in and buy it there. This is the guy who's buying the top. But then as it starts to depreciate, because there are less people in this pool than there is in the pool of holders over here, people that already own the asset. Well, now if you want to sell the asset, you're going to have to say, well, I'll sell it you at this price. And then someone's going to come and take it. But basically, because there's less people willing to pay these prices for the asset, the owners of the asset will have to keep dropping the price to meet demand. And when demand is met, then we may see a new drive higher when we meet a price that people are happy to start buying in at again. But essentially, what's going to happen there is, the price is just continuing to depreciate to basically meet the price of which demand exists, okay? So if you wanted to buy a car off me and I had this car and you didn't want to buy it at this price, I might have to lower the price down to here, see if you'll take it. If you're not gonna, I'm gonna have to keep dropping that price, okay? That's basically what we're seeing happen in the real markets. And although these drawings have been messy, I'm pretty sure you've hopefully caught along with them. So that's basically how supply and demand works. It's the same everywhere. Some reasons why, just very briefly before we get into actually using this, why demand may increase for an asset. Let's say we have the US dollar and the interest rate on the US dollar is 4.5%. And then let's say we have the euro and the interest rate on the euro, these are random numbers by the way, is 2%. Well, if you're now thinking of holding one of these for the long term, which one's going to be more appealing? Probably the US dollar, right? Because if you have $100,000 in the US dollar, you're going to gain $4,500 a year for holding that. Whereas if you have $100,000 in euros, you're only going to gain 2,000 euros a year for holding that. So there's a better yield in US dollars, which therefore is going to make the dollar go up and the euro go down, because people holding the euro will sell, opening up more supply and decreasing demand, and they will buy US dollars, which of course minimizes the supply or sinks the supply a bit and increases demand, okay? So that's one of the reasons why we may get supply and demand differentials in the market. Another one could be what we call risk on versus risk off, okay? I'm sure we'll go more into depth on these, but to understand just the basics of what drives currencies, we'll go through it now. So a risk off currency is a safe currency. Again, like the US dollar, safe haven currencies, right? The yen does pretty well. The Swiss franc, these are seen as safe havens, safe assets to put money in that are generally stable in hard times. So risk on assets when market sentiment and traders are happy to take on a bit more risk, that's going to be pretty much everything else. Things like the euro, the pound, the Aussie. These things are a little bit more speculative. So in a bad economic time, money will outflow these because people want to put their money somewhere safe. We see demand for these increase, therefore we could see price appreciation in these assets, okay? Also gold. If we take a look at gold right now, that's exactly what's happening, right? Let's just head over there. Gold right now, if we take a look at the weekly, gold, silver, these safe assets, these long-term assets, they're parabolic. They look like crypto charts. Why is this? Well, this is simply because hard economic times, we've got things like war, okay? In 2022, I believe that kicked off, which is, where we're looking. About this point, somewhere around here, war kicked off, Russia-Ukraine. Obviously, look at it since then. We have many other economic problems, a lot of things going on that basically people say currencies inflated, at danger of, geopolitical events. They're not so good to hold. I'd rather have my money somewhere proven and safe. So people then put their money into gold. That creates less supply, more demand. And this mix creates the perfect concoction to take us to, $4,600 per ounce, when a few years ago we were trading really never above 2. So another one of those is silver. These are two things I've been holding very long-term trades on. I've been holding a silver trade from down here, and we are now at $91, which is absolutely insane. So that trade is up like 400%. Why? Because simply the same reasons, right? Around exactly the same time, we started to see war, major geopolitical events. We were already kind of in the mix with COVID, pandemic, things like that. But now silver's gone absolutely parabolic. So that is why that happens. We see more demand coming in for safe assets. People buy that, and then price appreciates because supply is shrinking and demand is increasing. And if you're holding silver at this level, for example, if you bought in where I bought in, and now people are like, please, I really want some silver, you can say, well, I'll sell it you for this much, I'll sell it you for this much, I'll sell it you for this much. And that is exactly what's happening. All right. That's how silver is doing, as amazing as it is doing right now. So then another one we can look at real quick before we get into actually trading the theory is USD JPY. If we look at this on the monthly perspective, we can see the dollar has been appreciating against the yen very aggressively. This one comes down to their interest rates and monetary policy. So both of these are safe havens. So you should expect that if one does well, the other should do well, right? That's how it would seem on the surface. A safe haven currency, like we've seen gold and silver do well, we don't see one beat the other. You would expect that USD and JPY would move in pretty much the same sense, but this has the currency differential of interest rates, yields, and monetary policy. So as we said, the US has had interest rates at like 4% plus for the past few years since really trying to defeat that pandemic. Whereas that's because they were seeing inflation, right? So this was because of inflation. However, if we look at the other side of the picture, at the Japanese yen, the Bank of Japan was actually seeing deflation. So they have interest rates actually at 0 and sometimes negative, right? So they sit in this 0 and negative range, which is pretty wild. But this is because of deflation or disinflation. So basically their economy is just really not growing. There's obviously a lot of problems in Japan regarding the economy, population, things like that. But their economy is so flat that they have yields so low that borrowing is so cheap to stimulate the economy and get people spending money, okay? So that's why they do that. And then if we think about the US, their interest rate is high because inflation started spiking. So they wanted to slow down the amount of money people were spending. They make it more attractive to save. That creates demand to hold an asset. And they make it less attractive to invest or to borrow, even less attractive to borrow. So with it being less attractive to borrow money, businesses slow down, take less risks, and they just hold the money instead of spending it, which of course can create demand because people are like, well, there's big yield here. There's no yield here. So I'm going to move my money from Japanese yen into US dollars and hold that. And that is why when you look at the charts for those years, so let's say from 2020, around the time that the US started hiking interest rates, we've had pretty much nothing but direct upside. Because around this point, people started offloading yen and buying dollars, okay? And that is a case where demand increases, supply decreases, and the US dollar massively outperforms the yen. And that is why since around this point, we've seen nothing but pretty much clean upside for USD JPY. There's that disparity between supply and demand between the US dollar and the Japanese yen. As we see those high yields for the dollar and low yields for the yen, we start to see dollar demand increase, which creates the supply decrease. And we see yen demand decrease, which creates the supply increase. So with more money going out of the yen into the dollar, we see this on USD JPY. So now let's talk more about how we actually utilize this on the charts. I think I've gotten the theory across quite well, and you should understand pretty much what it is that drives the force behind this concept. Okay, so now that we've pretty much in full explained the theory behind supply and demand, talk about how we actually trade it on the charts. So when it comes to identifying and utilizing supply and demand on charts, we use something we call supply and demand zones. So these are basically price areas. This is how you've got to think of it. It's a price area that the market has created impulsive movements from that could therefore be utilized in the future for us to find good points to get into and sometimes out of trades as well. So what we have here is basically a indicated price move. So just imagine this is a candlestick movement or a price move in the market. This is obviously a bullish price move because the market's moved up. And at the start of the price move, we have a small kind of consolidative area where the market moved sideways a little. Now this area here, the consolidation before the drive higher, is a demand zone. So we classify this as a demand. Now the reason we know this is a demand and how we spot it in real time is basically after the small consolidative move, we have this large impulsive bullish push, right? This impulse higher, therefore, indicates that from this price area, we saw demand enter the market. Okay, so if you think about the logic behind what's actually happening, we have sideways price and then an explosive upward move. That shows us that somewhere in and around this area where the market went sideways, we saw a big influx of buyers. Okay, so a lot of people want to buy there. So buyers or owners of the asset keep pushing the price up and buyers keep paying that increased premium. All right. So what does that tell us? Well, it tells us that at this point, specifically the demand zone we have marked, this is where buyers stepped into the market in large numbers. So that is then classified as demand. So how we use this in a market then is if we understand where buyers are stepping in massive numbers, take it back to what I said about it being a price range rather than just a rectangle you've drawn on the chart. It tells us that between 250 and 260 in this example, using these numbers over on the right, we saw lots of buying come in. So if we think about the auction theory, that tells us that between 250 and 260, this was a good price to buy this asset. People saw this as a discount, okay? So because we saw a lot of demand pushing in from the 250 to 260 area, we could then anticipate that if the market was to return to that 250, 260 range, we may see another influx of buying, which could drive us to new highs because we already know this price is proven as a discount price to buy from. So if the market can get back in there, well, anyone that wanted to buy, but now sees, these higher prices as too late to buy, they will think, okay, we've returned to a discount price. We're at a good price range again. So I'm going to get in, and that can set the new baseline to drive the market higher. Okay, so that is how a demand zone works. It's basically a price range between one level and another level where buyers went heavy before, and if the market returns there again, it's already proven as a discount price. So providing the market is trending to the upside, we should then be able to basically use these pullback movements and the demand zones that come out of them to secure buys from there, given that a large number of market participants already see this as a discount or a good price to buy the asset. So that is how a demand zone works. We are basically identifying where did buyers buy in force before. If the market returns there again, that's where we should look to buy from because we know this is seen as a discount price in the market and we're likely to see another impulse from there again. Okay. So when we're buying in a market, we do not want to buy on the way up. We basically want to buy on the way down, but in a larger upward price move. So if we have a movement like this, we are not trying to buy here. We're not trying to buy here. We're trying to buy at these points. And this demand zone theory that I've just showed you is exactly how we make that happen. Now, let's flip this upside down real quick. This then is a supply zone. So this is the opposite. It works in the same way. You probably already understand if you got that example. But basically, we are seeing here a price range where sellers entered the market in large numbers, right? So if the sellers entered in large numbers here before, which obviously is indicated by a sideways move and then a large drive down. So this impulsive movement shows seller control. So we see sellers stepping in, buyers sell the asset to them for this price, then this price, then this price. So sellers are basically controlling the market. There's more supply entering the market. Demand is decreasing. So sellers have to sell this off for cheaper and cheaper and cheaper and cheaper until demand is met once again by the buyers. Now, if we then see the market pull back to this level, we know this is seen as a premium price to sell the asset. So anyone who is in a buy will want to get out as high as possible. So they'll be selling into a supply zone like this. And anyone that is wanting to sell would want to sell for the highest possible price because obviously then they make a good return, providing they're not, of course, short selling the market. So basically, if we see the market return to here, we're going to see people sell again. Same if you want to short sell the market. So you want to get in and profit from a down move. You want to do that from as high as physically possible, right? Because the higher you sell from, the larger down move you profit from in your short sell trade. So a supply zone is pretty much just the opposite of a demand zone. This is the selling version where supply is stepping into the market in force. This is the example where demand is weaker, supply is stronger. And what we want to do from those is sell the market once we return to what is seen by mass market as a premium price to sell. So that's a supply zone. Demand zone is the buy side version. And now we'll go and look at these on an actual candle chart. Okay, a quick interruption, quick little note. What you're learning here in the bootcamp about technicals is absolutely necessary. But technicals alone are not sufficient to get you to where you want to go. You're not going to win just off the charts. Whether you believe it or not, whether you've noticed it yet,